Hello everyone, and thank you so much for attending this webinar that we have today, Speaking from Experience, Startup Fundraising Q&A. So we have three wonderful experts that are going to be helping and diving in some of the questions that you've already submitted our way. If you have other questions, perhaps you can use the control panel here on your GoToWebinar, and we will see if we have some time to actually dive into those a little bit later. Before we jump into the action, I wanted to give you a little bit introduction about what we're doing here at Onevest. So as you see here, we've been lucky enough to really get some good momentum with the press and so forth. But really what we're doing is we are a curated startup investing marketplace where we connect early stage companies with accredited investors. So as you will be able to see, some of the deals that we have are on the seed stage, bridge, and then as well Series A. And the type of investors that you would find are angel investors, high net worth individuals, family offices, and then perhaps venture capital firms that are operating in the early stages. So myself, I'm going to be your host today and the moderator. And my name is Alejandro Cremades. I am one of the co-founders here at Onevest. And as you see here, my background is in legal, and then as well a little bit of business in there, and I've been trying to now lead this venture, or doing the best that I could since 2010, and we've been very privileged and lucky enough to see this crowdfunding industry evolving. So obviously there's a disclaimer that needs to be put in place. Onevest is not a broker-dealer. We have a broker-dealer partner that is WealthForge, and we are not by any means recommending any of the deals that are posted on the platform. Before jumping into the agenda, I think that it would make sense to discuss the community that we have. It's a community of over 50,000 entrepreneurs that we've been able to create as a result of the merger that we did between Rock the Post and Co-Founders Lab to form Onevest, which it was announced in July of 2014. We have a Co-Founders Lab, which is up and running, where people can actually meet their co-founders and build their teams. And we have entities such as MIT, Harvard, Cornell, and also accelerator programs like Techstars that are using this type of technology. So today the agenda that we have is really quickly how Onevest works. Then we're going to do an introduction to the panelists, and then we are going to jump into the Q&A about raising capital, where we're going to be touching all these questions that you did submit previously to this session today, which is going to be 1 hour. So really quickly, how the startups are sourced on Onevest. We only accept right now between 2 to 4% of the deals that are actually applying, of the startups that are applying to raise money on the site. And some of the programs that you would see here are either universities where the deals are coming from, accelerator programs, or some early stage investors that are perhaps the lead of that specific offering, which are referring that deal to be posted on the platform. So the way it works is very simple. Once we have the startup already on the site and there has been the necessary due diligence on the business and also on the legal side, we would go ahead, we would post the offering, the startup on the platform, and it becomes automatically available to our investors. So the way it works is the investors basically would pick the deal, then they would click on the investment button. There's going to be all types of background checks, and then to make sure that that investor is in fact a verified accredited investor, and then the money would go into an escrow account to provide certain safeguards. So that means that if you don't reach your minimum goal or the maximum goal, the money is not yet retrieved by the company, and that money will be retrieved at the end so that the startup is able to really fulfill the promises. So some of the deals that we've had that have been successful, for example, is Pristine. They raised $750,000 with our help, which is a telehealth company. 3 months later, they raised a Series A of $5 million. So we were very, very happy to be part of that. And then another example is SumXR, which raised $1.5 million with our help. And they are right now one of the best-selling energy drinks in Whole Foods. So that was a great story that we were very lucky and very proud to be part of. So the next point of the agenda that we have today, now we're going to be jumping into the action, which is the fun stuff. And we're going to be introducing the panelists that we have today with us. So we have Peter Fusco, who is a partner at Lowenstein Sandler. They are actually involved with almost 500 companies, I believe, and then as well they have been involved in over 1,000 offerings in the past 24 months. They are without a doubt one of the top firms out there, and I have a lot of respect for Peter, so it's definitely an honor to have you, Peter, on the line to respond some of the questions that perhaps those founders have today. I think that the legal component is critical, and making sure that the founders tackle that, it's key. We also have Ariel Poller, who is an entrepreneur, a mentor, and then also an angel investor. He has invested in companies as an angel like AdMob, SlideShare, or Flickster, and he has also been a board member in companies like Link Exchange or Odeo, and then he's also a member right now of the board of Strava or Freedom Financial. We have as well Frank Rothman, who is a founding partner at QED Investors. They are without a doubt one of the most well-known venture capital firms investing in the fintech space, and he is a board member on companies such as Global Analytics, Credit Karma, or L2C, and he has almost over 2 decades of experience in the consumer and also the small business finance. So with that being said, Peter and Frank and Ariel, if you guys don't mind putting your videos on so that our founders can actually put a face to the name, that would be wonderful. And I guess the first question that we have today, Peter, is for you. And that question comes from Jennifer. And she wants to know if you should approach investors who have invested already in similar companies to yours in the past. I know that, for example, venture capital firms like Uniscore Ventures had some trouble with investing in companies like Foursquare and some other companies that ended up competing in that same vertical. So I guess that your 2 cents here is going to be very interesting to hear.
Yeah. First of all, let me say thank you for having me. This is a great event. Great to be part of it. I think more than I think I think Jennifer's question should be just broadened a little into not just similar companies, but to looking at sector. So a lot of times, if you have, there's a number of reasons why you might go to any fund that has invested in similar companies, but I think more importantly, you want to find someone who is invested in similar, possibly similar sectors, and maybe in something that, you have different stages, right? So social media, you have different stages of companies that start out, somebody owns it, several fail, and depending upon, where the fund or the investor was looking into that segment could mean that, one investment might have been too early for the market, and, maybe there's something better. If you look at MySpace was good, then Facebook came along. Before that, you had like GeoCities back in the dark ages. But I think when you're looking at it, it's, I don't know so much similar companies is that great unless you have, unless there's something that there's some kind of nexus or strategic supplement or something that you do that they don't, because there's not too many. I mean, there probably are some, but I don't think there's a whole lot of people who are betting on 2 horses in the same race. But if they have an interest in this sector, and maybe some prior investment or some prior venture didn't pan out the way it should, doesn't necessarily mean that they probably wouldn't take another look at something that's an iteration along and may actually be the one that could take the market. Because, like with everything, there's people who arrive early, but there's the area is sexy, so everybody's putting money into it, and then there's people who maybe don't arrive first, but arrive second or third, and they've kind of figured out some of the bugs, and maybe the ones who take it all away. So I think it's an analysis of, sector, maybe prior companies, performance, and where the portfolio stands. If you're thinking, the good thing is that you'd be going to somebody who knows the market, has experience in it, and understands the sector you're operating in.
Got it. Wonderful. And the next question is for Frank. It's from Merdat, and the question is, how do you identify and ultimately convince someone to become your lead investor? Obviously, as a venture capital firm, that's the same question that every founder has, but I guess some guidance and color on this subject would be very much appreciated by the people listening.
Sure. It's an interesting question, but at the end of the day, the whole fundraising process is really a mutual dating exercise, and you should think about it that way, where the founder is trying to convince the venture partner that the idea, the sector, the business plan, the addressable market, the problem that they're tackling, is one that's going to be solved by this company and this person. And through that process of examining the business, spending time with the founder, spending time with the management team, either the investor falls in love with you or they don't. And there aren't things you can do to convince them to be your lead investor if they don't fall in love with the idea and they don't fall in love with the company. So the best thing you can do is just stay true to your vision, stay true to your business plan, and at the end of the day, just keep revealing more and more information until they're ready. There's not much you can do if they don't absolutely fall in love with the idea.
Yeah, that's a great one, Frank. So Ariel, the next one is from Andrew. It's for you. And his question is, what is the best way to get meetings with angel investors?
So I really like Frank's analogy about dating, and I think that that plays into this question as well, which is before thinking about how to contact, you have to think about who to contact. And I would say that the most important factor in determining the success of your approach to investors is who you're contacting. So if this is someone who's unlikely to have chemistry, it's unlikely to be a good date, if you will, it's not going to matter whether you send a love letter, a phone call, a text message, an intro to a friend. Once you meet, she or he is going to go, oh, no, I don't like you. So most important, try to find someone who is going to be a good fit, and that means that they've expressed through their blog, through their tweets, through their investments, interest in things, or have said things that make you feel like they're going to be a good fit. Once you do that, I would say you're halfway there, because if you reach out to someone who is likely to be interested, then how you do it becomes a little less important. Of course, it is ideal if you can do it through someone they know. As you know, this is a lot of people say this. Don't try to do a cold call. Try to go through somebody who you know. Maybe even if it's 2 degrees. For me, I'm in Silicon Valley, so that makes it really easy. People in Silicon Valley, it's 1 degree away from almost anybody, or 1 or 2. But I would say that if you cannot do that and you have to do a cold call, then at least make it super relevant. It's not some random, hey, you're a great investor, I'm a great company. Because you said this, because I'm doing that, try to make it personal, try to find the angle. And then there's everything in between. So sometimes people approach me after I speak at a conference, or again, try to find opportunities rather than just a random LinkedIn message. And if it comes to that, success rate is low, but you do at least stand a chance if you make it very, very targeted and personal.
Yeah, I guess that's a good point there, Ariel. I guess that the personal connection is critical, especially when you're doing this type of business, right? I heard yesterday from someone that told me divorcing an investor is harder than divorcing your own wife. So obviously it's really good that you find that angle, that way to really connect with that individual, because in the end the relationship is everything, right? So
actually, I don't know, I don't know too much about religion, but there's some religion which you cannot divorce, right? So that's the religion that we live in. In most cases, you simply can't. You're stuck.
Right. I totally get that. All righty. So the next question is coming from a founder. I guess there's a lot of founders. We had over 1,000 people registering today. So you guys are definitely rock stars in the field, and it's an honor to be here with all of you. But we have a bunch of founders that are foreigners. And one of the questions here that we have from Steve is, for Peter, what are your thoughts on incorporating a European company in Delaware in order to have the business up and running in the US? And I guess that this is a question that is critical, because I believe that there's some investors that want to have, to a certain degree, the operational structure here close to them and so forth. So what are your thoughts on that, Peter?
So it's a very good question, and it's we're doing a lot of work now flipping European companies into the U.S. and opening subs. So I'd say it depends. So for starters, it depends if the company is already formed in Europe. So we have a lot of clients who are European companies formed in Europe and then come to us and say, hey, we're looking at trying to get venture investors, and a lot of the people we're talking to aren't entirely comfortable investing in, like, a French SAS or, some type of European entity, because people are mostly, the overwhelming majority of investors in the United States and funds are used to Delaware C Corps, because everybody gets that. So where you end up is, so it's kind of a bifurcated question a little bit. Where you end up is, if you have an entity already in Europe, the question is, do we form a U.S. subsidiary for purposes of presence? In which case, many do, so that they have a U.S. presence doing maybe their marketing or some operation level type work. A lot of times, if you're already there in Europe, people will do what's called a flip, where you flip the company into the U.S. company and create a reverse parent-subsidiary relationship, so that the U.S. entity now becomes the parent, and the operations that are in Europe stay in Europe under a European subsidiary. And that way, investors who are coming in, they won't care so much that, your development team or your engineers are in France or Germany or wherever, and you have entities there. But what they want to know is what they're investing in is the parent that ultimately owns everything, right? Because chain of title and IP is huge. So people don't want to, if people want to invest in an entity, they know Delaware C Corps. They understand what preferred stock is in it, what fiduciary duties of directors and officers are, and that's a comfortable area for investors to invest. So what I would say is, depending upon the specifics, you should probably reach out to, your lawyer if you have a European lawyer, if they have a U.S. lawyer. There takes some coordination on that to come up with what's the best scenario for what you're shooting for. And sometimes it's you flip your company into the U.S., sometimes you just open a subsidiary here. It really depends on what the ultimate goal is. But by and large, U.S. investors want to invest in a Delaware C Corp. It's not 100% of the time, but the overwhelming majority look for that because there's certainty and precedent.
Got it. Thank you, Peter. I guess that the next question from Soteris, it blends very well with this one, and this one is for Frank. How venture capital firms make investment choices regarding non-U.S. startups?
Yeah, it's a good question, and the first thing you have to realize is that not all venture funds are comfortable investing outside of geography. So, starting with venture capital or private equity funds that are comfortable is a good first step. And you can find that out by looking at the investments they've made, look at the partners that they have, and figure out if they are actively making investments. And, if I take QED as an example, most of our investments are in the U.S. And part of that's because we're very hands-on investors. We pride ourselves on being operators disguised as investors, more so than investors first. And it's because of our operating backgrounds. And because of our need to touch businesses, spend time with them, be on-site with them, makes it very difficult to invest in an international business. But we've made some. We have one investment in China, we have an investment in Stockholm, we have a few that are in the UK area, and it's definitely possible. We even have a few in Brazil now. But what I would say is, to get us comfortable making an investment in another geography, you have to collapse the problem to one where the only thing that isn't known by the investor is the geography. Right? So if you're trying to convince them about a business model that they're not familiar with and convince them of the geography and all of the things that they don't know, it's just a very difficult challenge. But if they've seen businesses, know businesses, have invested in businesses that are very similar to yours or in a domain that they're already comfortable with, and all it is getting familiar with the environment, then you actually have a chance. And in fact, it could be a great way for them to diversify their portfolio while still feeling very comfortable with the investment.
Got it, got it. And I think that this next question, Ariel, I mean, I to a certain degree feel identified, is from Gavin. And his question is language a barrier for a non-native co-founder to do fundraising? And myself, I'm from Spain. I mean, it's hard to deny the accent that I have, right? And obviously you as well come from this Latin American background, Ariel, and you've been a successful founder here. So I would say, from the founder perspective and angel investor perspective, what would you say to Gavin?
Well, the first thing I should say is, so I've been now in Silicon Valley for 20 plus years, and my experience is very limited to Silicon Valley. And relating to the previous question, Silicon Valley, for us, anything we cannot drive to, including Sacramento, is foreign. And what I feel is that the way things operate here is so different than the way things operate in most of the rest of the US and the world. So my answer is very specific to here, and I think that the East Coast and other places in the US and the world are not the same. Having said that, what I found here in Silicon Valley is, nobody's from Silicon Valley. We're all from somewhere else. And whether we come from Venezuela or you come from Florida, it doesn't make a difference. Now, language, and remember, if you come from Texas, you have an accent. If you come from Boston, you have an accent. So if you come from Latin America, you have an accent, or India. The accent is not a problem. Being a foreigner is not a problem. Now, being able to communicate, now that is important. So if your English is so poor that you actually can't communicate clearly, then that's a problem, because, communications are very important. And I would argue there might be some people who are native English speakers who still have communication problems. So at least here, if you look at the statistics, the percentage of successful entrepreneurs who are foreign is huge, and nobody should feel that that's going to get in the way. If they can't communicate clearly, that is problematic, and then I would suggest that anybody who wants to do business in the U.S. As an entrepreneur should make sure their English is clear. Again, not about an accent, just about communicating clearly.
Yeah, I hear you on that, Ariel. I still remember on one of my first pitches, one of the investors on the panel told me that the presentation was great, but that I needed to learn how to pronounce better the word entrepreneur. So I was going entrepreneur for 30 minutes with him. He ended up investing, so I guess that probably I learned how to pronounce it well. But yeah, that was a cool experience. And the next question for you as well, Ariel, is from Xie. And Xie is wondering, how does one founder find angel investors for seed funding outside of the personal connections? And I think this is kind of like the comfort zone, right? And it goes kind of like a line with as well with the accent that we were discussing now. So how would you recommend these founders going about that?
So what I would say is not the same answer applies for everybody. Like in most things we're discussing here, it's very personal. Different people have different approaches that work for them. Some people are more introvert, more extrovert, etc. So you obviously want to try to leverage all the network you have. It might be your school, it might be your country. For example, sometimes I get somebody from Venezuela who I don't know, and they say, "Hey, Ariel, I'm from Venezuela." That makes me want to help them. Or I went to, somebody who went to the same schools that I went to, and so on. So try to find that as a potential angle. You could potentially be proactive and attend seminars and courses and conferences, networking events. Those kind of things work pretty well. There are also the platforms like the one you guys run, and there are lots of other platforms where now there are, I believe, tens of thousands of angel investors that are coming to this platform. So those are, I think, great mechanisms. It obviously helps if you start to get some traction, maybe get some press, and you can leverage that. And, every little bit helps. So yeah, I don't know if that's hopefully.
Yeah, no, that's great. That's great. Thank you, Ariel. Peter, the next question is for you from Dean. What is the best offering structure for an early stage startup? And I think that this is very important, because once you're messing things up at the beginning, it's going to be very hard to apply surgery later on. So what are your thoughts on that?
Yeah, so in terms of best offering structure, I think it depends, right? And I think when I say it depends, it means, people think about, should I do convertible notes? Should I do a small series seed round? Should I do, safe instruments are gaining a ton of traction on the West Coast. They're starting to pick up here on the East Coast as well. Depending upon how much you're going to raise and what your goals are. I'm a big proponent on the company side of trying to push your valuation off as long as you can. Because, somebody giving you 250 grand today, that 250 grand in an equity investment is probably going to be worth a lot more in terms of percentage of equity than it might be 8 months from now. So, historically, and I think we'll get into this later on in more detail, but historically people would say, hey, I'm just raising 100 grand or 250 to start. I'm going to do just a note round, get myself 18 months, bring a note in, do, a discount or a cap, and kind of fold that into what is hopefully your Series Seed round or your Series A round. So I don't know that there's necessarily a best way to go. I think part of it depends upon who your investor is and what they want, right? Like some investors will come in and do 250 or 500 and say, we don't do notes and we don't do, convertible securities, we do equity. So let's do a priced round. And, so that's all part of the process, but on the company side of the coin, I've always been kind of a big proponent of trying to, if it's very early, trying to push the valuation component further down the road and fold it into your Series C or your Series A.
Right. I guess the next question as well, Peter, would be interesting for you, given what we were discussing now, is from Uday. And the question is really convertible note versus equity rounds, right? I guess that's one of the biggest doubts or questions that arises, especially if you're like earlier on, like on the seed stage where the revenues, for example, are still not there or are about to get there. Like, what are your thoughts there on that?
So if if the question is, do I like convertible debt versus equity for a seed round at an early stage, I do like convertible debt. I'll tell you that, historically people said, oh, you should do convertible debt because it's much cheaper than doing a seed round. Over probably the past decade or so, that's kind of become less true because people have streamlined the equity documents to, be able to, you can probably these days put together for an early stage company a Series Seed round with light investment documents like the MVCA docs, but a lighter version, and a note purchase agreement or a note deal probably within the same price. Assuming the company is very early, there's not a lot of diligence and there's not a lot of problems with the company. That being said, from the company's perspective, if I have to pick between debt and equity, I like debt, but debt at a certain point can become problematic. So, traditionally, I think there was this, $500,000 is this cutoff area. And then nobody was really doing a ton of deals between 5 and $1 million, but $1 million up, everybody said, oh, that's a seed round. And I think what you have to think about in debt, and this is where, when we get into the safe instruments is an interesting thing. The issue with debt is the higher you go in taking debt, you have to factor in the discount and you have to factor in the interest. Because if you do a debt deal for, let's say you do a debt deal for $2 million, just as an example. If you do that, your seed round or your A round, you're now precluded from probably doing a smaller round, and you have to figure out how to take in like $5 million. Because the two most investors who come in and do the round want to lead the round and have control of the round. They're not going to say, oh, we'll do another 2 in the seed round, and then the note holders who are sitting around with $2 million plus discount and interest control our seed round. That's not going to work. So debt, I think, is good early, but only if it's used right and it's for lower amounts. I think as you climb in amount, you get closer to having to think about just doing it as an equity round.
Got it. Makes sense. So Frank, I guess that when companies come knocking on QED, I hear the word traction too much. So let's talk about traction now. What happens when there is like really a founder, like here, for example, we have Katie, who is asking, what is the best advice for pitching your startup when traction has not yet occurred? That's a tough one.
It is, and I guess it depends on what the definition of traction is. Because traction can be building a product, traction can be selling into customers, traction can be getting commercial relationships in place. So it really depends on the business itself. But what I would say is it collapses down to the fundamental concept of why the investor would be investing in the first place, and having conversations with them about the typical topics like how large is the addressable market. Are you attacking an acute pain point in the marketplace? Is there a distinct financial model that makes sense? And one of the big things that's very important for us is making sure that what it takes to succeed isn't something that I've kind of coined the 0.8 to the 5th issue. And what I mean by that is, in some businesses, you need so many things to go right in order to believe in them that even if you believe the entrepreneur is great and they have an 80% chance of success on any given dimension, if they need 5 things to go right in order for you to feel comfortable that there is a real business there, 0.8 to the 5th is really a small number. So you've just pitched a plan to an entrepreneur that basically, from an entrepreneur to an investor, that is very, very low odds of actually succeeding. And you need to internalize that when you're making the pitch. So if it's a 0.8 to the 5th type of business, the investor is obviously going to push it off and going to say, well, why don't you prove out 1 or 2 of those dimensions first? And that's what they mean by traction. You know, de-risking it so it's not a 0.8 to the 5th issue, but it might end up being maybe 3 dimensions that they need to solve, but 2 of them, they have some proof points that there is something there is a pulse of response within the population. You know, that whoever their target customer is, you know, the dogs are eating the dog food. You know, if it's not a 0.8 to the 5th type of business, traction can look very different, right? If it's about just proving that if you get this in front of people, they buy, you know, that's a very, very different type of business, and proving traction in that business has a very different standard as well. So, I mean, what I would say is just be clear at what you need to prove for an investor to be comfortable that your business is real. And, you know, the bigger the challenge, the more things that have to be true for your business to come true, the more likely they are to ask you to flip over some of the cards first before they put their money in. Because, again, you know, 0.8 to the 5th is a small number, but, you know, there are plenty of businesses that don't have that many contingencies. So I know that's generic advice, but I would say just be aware of what you're pitching.
Yeah, and here's the thing, Frank. There's a lot of people talking about traction out there in the investment world here in startups. But I think that the way you actually define traction and the way you outlined it for the founders that are listening, I'm sure it really added a lot of value and really made a difference. So that was fantastic. Let me ask you this as well, Frank. This one comes from Daniel. What makes up the most important part of the decision to invest or not to invest for you guys at QED?
Wow. You know, one dimension it's pretty tough, but I would say it boils down to conviction. If the partner that's aligning with the founder does not have conviction, you know, an inherent belief that the business plan that's been, you know, put in front of the investor, with the quality of the management team, with the plans going forward, if they don't have conviction that they're on the right path, then there's no way you're going to invest. But if you have conviction, you're going to be able to sell that idea to other people, you're going to be able to get behind it, you're going to be able to help the founder. So a lot of it just comes down to boiling all of the dimensions, you know, into, do you just fundamentally believe that this is the right team with the right idea and the right marketplace to attack? When the answer is yes, you're going to figure out a way to invest. Got
it. And Ariel, I guess the next one is for you and goes in parallel with this answer. I probably not. It's from Kevin, and Kevin is wondering, what key milestones should a startup have before seeking angel or seed investments?
I mean, I don't think you should be so black and white or so structured and say, oh, milestone this or milestone that. I mean, what I have found is most investors, particularly in the earlier stages, what it takes us to invest is that we get excited. It's excitement. It's not about check, the team, the market, the traction. Something gets us, because what happens is, for most of us, particularly those who are pretty active, we have many more projects that are good, that have all the checkboxes that we can do. So how do we pick the few that we want to do? And it usually is what we get excited about. Now, sometimes we get excited because we love the product. Sometimes we get excited because we love the team. Sometimes we get excited because it's something that would be a good thing for us. And I've seen plenty of situations where the investor gets excited and there's some holes. They have a hole in the team, or they have a hole in the business model, and they still do it because that excitement drives more. So I would say that it's more about the moment you're committed to the idea and you're going for it and you're ready to say, yes, this is for real, and I'm willing to make a commitment to external investors that I'm not backing out, that I'm not changing, then that moment it's good enough. I don't think you need to wait for anything, because I've seen plenty of investors, particularly the best investors, who invest really early. Invest on an idea, invest on an envelope where you wrote it, or a napkin where somebody's wrote it. So this notion that, oh, well, don't go do it until you have this, this, and this, I mean, I think it's more of like an average, but you don't want to play the average. You want to, once you're excited and you're ready to make the commitment, I don't think it's ever too early.
Got it. And you know, funny enough, Ariel, we have people that are already getting excited with that answer. And we have Kimberly here saying, what usually makes you want to schedule a meeting with a founder after reviewing a pitch deck?
So when do I want to meet? So I mean, I try to do as much before the meeting as possible to be efficient with my time and the entrepreneur's time, obviously. And I mean, the things that I look for are, I mean, it's a good fit for me, and that means that, for example, do I understand it and can I help? I only get involved if I think I'm going to add a lot of value, which is the way I have fun. So sometimes I'll see a great business and I go, you know what? It's just not a whole lot I can do here. So that's not something that I would do. And then do the initial interactions, even if they were via email or on the phone, do they make me feel this is somebody I was going to enjoy working with? Is the market something that seems exciting? Is the product, again, it's rarely about all these things have to be there. Usually one or two of the things catch me and go, oh, this is great, I want to learn more. And so don't try to fill all the check boxes. Try to find one or two things that gets that target investor excited about what you're doing.
Got it, got it. And the next thing, or the next section or question, we have it from Kevin. Before I actually ask you that question, Peter, I mean, one of the things that founders really have in mind when going into a round is how much are they going to get diluted? I mean, I'm always of the idea that if you're bringing strategic partners that are going to add value, I mean, in the end of the day, it's better to have 2% of $1 billion than 100% of nothing. So I guess that with that in mind, Peter, let me ask you the following. What percentage of equity does the investor group generally require at a seed stage and at a Series A stage?
Right. So, and there are some people who want 100% of nothing. But I would say, so let me start at Series A and work backwards. I think when you get to your Series A round and your B round and you're moving in that range, you should probably assume you're going to end up giving up a third. Some Series A's in the last probably 27 months have been between 25% and 33%. But the overwhelming majority, when you hit that stage and move forward, just the mechanics of the investment are, you know, just end up being about a third of the company. And you'll have, you know, I have been at a couple of dinners with a bunch of founders who were growth equity, did private equity, took some money off the table, and their advice to all of the founders who were earlier was get as much as you possibly can because it's going to cost you a third no matter what you get, which was interesting. It was interesting advice, but the number seems to end up in the 25 to a third range unless you're, you know, a company that's just taking off like a rocket ship and has the leverage and people just want to jump on board. But typically, I'd expect 25 to 33% on the seed rounds. You know, if you're doing a seed round, probably looking at it maybe somewhere from maybe down to 18, but for the most part, you know, a seed round, and when I say seed, I'm thinking $1 million to $1.5 million as a seed. At that range, you know, I'm seeing a lot of them at 25%. But once you get into the A's and you get above that, you're at 33. You know, it's just, it's where it winds up. So if in your head, if you say 25 to 33 for these rounds, you're probably thinking in the proper context. And it's also what makes people want to do debt or safe instruments earlier is to try to fold these things into the later round and not take the initial dilution you would have at the seed stage.
Right. And I think that the next question is very similar to this one, Frank. And I think that as a founder myself, I mean, when you're putting together a pitch deck, right, on that ask slide, you're always wondering, like, yeah, I mean, this is what I would need for the next 18 to 24 months, but is this going to be a fit with this firm? Is it not going to be a fit? So the next question from Perry is, how do you determine how much you should ask for?
Yeah, it's a good question. And, in this world of constantly looking to de-risk the company and prove things out in the business model, you need to work backwards from learning, right? So ultimately, every single stage of raising capital should be, have a goal of de-risking the company on at least one critical dimension, if not more. So figuring out what needs to be true for you to have a very robust, high growth business that eventually, crosses whatever finish line in terms of economics or customer base or whatever metric actually matters. So you've got to work backwards and say, what does my learning agenda look like? What am I going to be able to prove out with how much capital? And you have to be very realistic about it. You need to say, if I take this much capital, what cards am I going to be able to turn over to then say, the business is different today than it was when I last raised money? Here's what I now know about the business that I didn't know before. And sometimes you cross some seminal points, right? So you might cross the point of profitability. That's a very important goal at some point, to have your fate in your own hands. You might cross the point where you say, I'm able to actually prove out a marketing channel, right? That's a very important point. You might be able to prove out that you can develop the product if you're at a very early stage and that you can get it into market. Right, so you really have to take on enough money that you've gotten to at least the next threshold, however you define that, and that you're convinced and the investors coming on board are convinced that that's going to be enough to attract the next round of capital. So, I hate to work backwards from the next money in, but, businesses are consumptive, right, in the very early stages, and you have to keep an eye towards proving out enough with the capital you bring in that someone is going to be willing to write that next check. Mainly because it's hard to achieve your destination with 18 or 24 months of runway and one investor coming in.
Right. Yeah. And I guess that when we're talking about a little bit earlier in the stage, right? And this one is for you, Ariel. JC is wondering, how is the equity determined for investors when there is no revenue?
Sorry, you broke up. You said how is what determined for investors?
So obviously the type of deals that you see, or obviously as an angel investor, are a little bit earlier in the stage, in which, for example, the deals that, for example, Frank may take a look at, Series A and so forth. How is the equity determined for investors when there is no revenue?
So actually what I have found, and I have been fortunate enough to be involved with super early friends and family, seed, Series A, B, C, late, public, you name it. And some of the companies that I get involved with as the seed stage, grow, and then I'm there and see the evolution. And actually what I have found is that it's not that different. And what I have found is that it's primarily has to do with supply and demand, with the market, with basically how many people how attractive is this company, how many people want in, and then that pushes the price. And I've seen, Peter was giving some ranges of what he sees in terms of equity that you give up, and those sound like the right averages. But I tell you, I see companies that are very hot and can raise an early stage round and give 5% of the company. Or on the other hand, I see companies that are struggling and have to give half of the company, but that's what it takes. So it's definitely not a formula, and actually sometimes it gets more complicated. The farther you are, the more metrics you have, then all of a sudden more calculations need to be made. Earlier, it's more like, well, let's see, usually Series C, it's seed, and we're raising $500,000 to $1 million, so let's do a $4 million valuation. When they take 10-15%, it's very much very more art than science, very unorthodox. And it varies dramatically the moment you have multiple people. If you have multiple people trying to invest, and you see valuations potentially go to the roof. On the other hand, if you're struggling, you need the money, you see them go down. So it's really all over the map, unfortunately. If you're fundraising, try to talk with entrepreneurs and see, well, what did you get? Because it's a very big difference when you have competing investors versus individuals and one time, and you have to go and tell them, look, I'm raising $500,000 and this fee to focus on getting people excited about your company and then being accommodated rather than obsessing too much about the terms.
Got it. I guess that Snapchat, for example, wouldn't be a very good example to throw here, early stage founders, right? Raising at a $19 billion valuation with, perhaps the revenue is still trying to figure out. But I guess it's like what we were discussing, right? Like there's some metrics that really prove growth, how you acquire the users and so forth, that not necessarily are talking about the revenue that the company is producing. Go ahead.
If I can add one more thing, another really big factor, and by the way, I happen to be familiar with Snapchat, actually a company I was on the board of, acquired by Snapchat, which got only disclosed when the Sony documents got stolen. What I was going to say is super important is how the founder negotiates. You wouldn't believe how many situations I've seen in which just an aggressive founder, an aggressive entrepreneur pushes the valuation way high, or on the flip side, some entrepreneurs or founders who just are less aggressive, are more focused potentially, which might be a good thing, on getting the best possible investor. So just everything else being the same, you could end up with very different results.
Got it. Thank you so much, Ariel. The next question, Peter, we're talking about raising money here, and I guess that the next question from Sharon is an interesting one, especially we're talking about, investment platforms, other venues in which you see syndicates happening. What are, from Sharon, she's asking how and why do you group investments in a round?
So in terms of, I assume what she's asking is, how and why do you group things into your convertible note round, or call it a seed, or call it an A? And assuming that's the case, so I guess historically, I always joke because we Series Seed wasn't a big term until probably, I don't know, 2006, I think, 2005. Before that, people just did A's and B's. Occasionally we come across people who would say, this has to be my A round. And you could really call it your Z round. But the reality is people started to identify these rounds with kind of signaling some type of optic in the company. So people look at a C round or a B round, or a B round is like, maybe a growth round. A C round is a private equity round. An A round is maybe its commercialization. The reason the reason at a core level, the reason you put all of these groups into different investment groups and rounds is because you're dealing with the valuation issue, right? So if you only need $1 million up front, you kind of aggregate everybody into a round that says, hey, my company's worth $5 million, you're putting $1 million in, that's $1 million on a $6 million post money. I don't know what number that is, maybe 16%, somewhere around there. That's my seed round or my A round or whatever it is. Now, as I build more value, 12, 18 months down the line, we hit some milestones, we've hit the next big thing that makes us valuable. Now I'm going to go out and raise my next piece that maybe gets us to a growth stage to build out. I'm going to put those people together, and now I'm going to say my valuation is worth $20 million, and I'm going to look for $5 million to build out. So at its core, the reason you're kind of segmenting everybody into these investments is in different rounds is because you're hoping that you're ramping your valuation up over time, and that's why you're doing this. There is some kind of I think there is industry optics to when you're saying it's my seed. So okay, maybe you're pre-launch. Here's your seed money. Your A is maybe launch and a little commercialization. Your B is growth. I think and different people interpret those differently, but I think it's at its core, you're staging the investments because you're trying to have an upward trend in your valuation, and essentially give away less for more over time. But there are kind of optics to it as well, and I think they've become increasingly more important to some people over time.
And we've been discussing during these sessions. We've been talking about traction. We've been talking about the dating game, right, between the investor and also the founder. This founder is wondering, Diaz, when developing that relationship, and this goes for Frank, when developing that relationship and building the trust with the VC, how often should I provide updates to show progress and traction?
Yeah, I mean that's a very investor-specific question. So for an investor like
we're not trying to have your inbox of your email exploding by the end of today, Frank.
Yeah. You know, when it comes to building trust before they're invested, you want to make sure that you're communicating when there's real news or answering questions that the VC partner has. So, you know, sending through every little email from some new potential customer before you've closed them might be too much. But if they have a question for you about how much traction do you have with potential channel partners or, you know, with relationships, contracts, then that's a relevant thing to provide feedback on. So a lot of it depends on what the line of questions are that they have in order to complete their investment decision, and communicating on the things that are relevant to the VC around that. And a lot of it is really just figuring out the cadence. Sometimes hopping on the phone and having a weekly call and, you know, reviewing a lot of the things that are left to be done is as if not more important than sending through, you know, information on emails from your customers. But again, I would say it's very specific to kind of the analysis of the opportunity, the relationship you've built, you know, with the investment professional, and you know, you just figure it out live.
Got it. Wonderful. So we have right now is 1:55, so we have room for a couple more questions. The next question is for Ariel. What similar patterns have you been able to identify on your most successful angel investments? This is from Joseph.
Yeah. I would say that when I look at the most successful companies, I wish I could say there's one pattern and then now I can only do successful companies. But different companies that I've seen have been successful for different things. Clearly, some of the most successful ones that I've seen that I've been involved with, you know, like Cana Software, Freedom Financial, what they had was founders who identified a very clear need. So definitely it's something that it's clear that it's needed, and then they would quickly provided a solution. So I met them, and they were really early, but look, here's a problem, here's a solution. So as opposed to, I mean, contrasting that with situations where it's like, well, I'm coming up with something that I think people will want, or I'll think it's going to solve a problem, but there's a lot more of a guessing game, if you will. Now, some of those obviously can turn out to be huge. I'm not saying they won't. Let me just say, and I know we have very little time, so I'll just say one thing, which is there's a big question, which is is it a good founder with a crappy market, or a great market with a crappy founder? And people have different points of view. Personally, I have found that the great markets tolerate a lot of mistakes, and I've been involved with a lot of companies that executed very suboptimally, yet still did amazingly well, just because the market was just exploding and they were at the right time at the right place and they hit a nerve. On the other hand, I've been involved with some amazing entrepreneurs who were just, they were onto the wrong thing. And sure, some of them eventually pivot, and you'll hear investors say, well, a great team, they'll find a way. But that hasn't been my experience. My experience is that a great team, if it's in the wrong market, yes, eventually sometimes they give up. On the other hand, so if I had to narrow it down, I'd say, well, a great market with a lot of potential, with a product and a solution that makes sense. And then on the team, for me, it's more about, do I like them? Do I want to have them over for dinner and spend time with them? And if I get that check, then that's good enough for me.
Right. And I guess that we're touching now on the mistakes, and we're gonna dive into some of the juicy stuff here in the fundraising process. And I guess that, Frank, you are the one to answer this one, and it's from Livio. And the question is, what are some of the common mistakes you've seen entrepreneurs make in the fundraising process?
Yeah, I mean, there are a lot of them. And I think it starts with how receptive are they to actually listening? If an entrepreneur comes in to look for money, they're looking for money hopefully from experts who are well connected, that understand the space, that have a very different perspective than the entrepreneur might. They might have seen hundreds, if not thousands, of businesses in a similar spot, that the entrepreneur should want to hear feedback and hear the questions from the potential investor. And I sometimes poke the bear on purpose and ask questions of founders knowing they're controversial questions and see how they react. And the best entrepreneurs react well and spend time trying to understand your questions, work with you to get answers for them, and some of the ones that make big mistakes are ones that dig their heels in and try to prove you wrong. So, there's a lot that can go wrong in some of that dialogue between an investor, potential investor, and a founder. Other mistakes include using very poor analogs in the marketplace. So pointing only at a winner who's winning maybe for the wrong reasons. Disrespecting the competition. I see this all the time, where they say we are better, even though they are the giants out there. We are going to win, and let me tell you absolutely, definitively, 100% why we're going to win. And I have to have a conversation with them about saying, I want to believe you because I want to invest in someone who has conviction in their business and their idea, but I want to let you know you're statistically wrong, right? I mean, the chances of a startup actually succeeding are very slim. And the best entrepreneurs engage in that dialogue to say, well, where could I fail? Why could I fail? How could I fail? How could the competition actually come in and do what I'm doing? And, when you engage in that dialogue, you see how receptive they are in what will be a changing marketplace and a very competitive environment to succeeding. And, in that same vein, you hear things come out of entrepreneurs that say, this is a giant market, we will get 1% of a giant market, and therefore we are a giant company. Like they've almost leapt all the way to the conclusion when it's really about a journey, about proving things one step at a time, and they're jumping already as if they've succeeded. And, entrepreneurs like that, I mean, God love them. If they can get there, that's great, but it's really a series of steps. And if they don't respect the steps along the way and respect how difficult they're going to be, it's tough. And, the example I use here is in our portfolio, probably the gem in our portfolio is Credit Karma. We were the first major institutional investor in Credit Karma. And for 5 years now, it's been a 45-degree angle straight up in performance. And, per the last topic of conversation, it's a great market. It's the right business model at the right time in the right market with a great management team. And, when we originally approached, Ken Lin, who is the founder, and had conversations, he was so paranoid about everything that could go wrong, but was realistic about his plans, pragmatic every single month about what he was going to do and what he was going to prove, that I felt very comfortable that even though there was a lot that had to go right in order for this business to succeed, I was going to be working with a founder that understood what it was like to be an operator. And he was very realistic about where the risks were and realistic about how he was going to move forward. So I know there's a lot in that, but hopefully it conveys a little bit about big mistakes, mainly about just not respecting how difficult the challenge and the journey really is.
Yeah, and I think that's a great answer there, Frank. When you were talking about being disrespectful with the competition, right? I guess that in the end, yes, companies are competing, but you shouldn't really treat them as enemies because in the end of the day, when we're working in this environment, when things move so fast, you never know when your competitors are going to be or where you're going to be. I mean, me, for example, I had a call with one of our competing platforms today just to ask the founder how he was doing. And there's nothing wrong with doing that. Obviously, you're not going to disclose your secrets because ultimately it's all on the execution. But there's nothing wrong with having a good relationship and a healthy way of really dealing with one another. So anyways, with that in mind, we're going to jump in here into the closing remarks. But I want to thank you, Frank, for participating with us today, Ariel as well, and Peter. It has been wonderful to have you participating in this panel. I am sure that all our founders were able to get a really immense amount of value, and I'm sure that you did make a difference today with some of the different steps that they're going to have to take on their business. So thank you so very much for being part of this today. Alrighty, so just to close up here today, I just want to let you guys know that you can go into learn.onevest.com to be able to see some other articles, videos, and some other words of wisdom that perhaps would be able to guide you in the process of building your company. We are definitely here at Onevest more than happy to help. It could be either via the financing that we are giving on the Onevest platform or via the Co-Founders Lab platform in which we're helping people to build their teams. So with that in mind, I would like to thank you all as well for being part of this webinar with us. Without you, we wouldn't be here. You are what really makes us get out of bed every day. And for that, I really thank you, and I'm very grateful. So thank you so much, and all the best. Take care. Bye-bye.